Hello, welcome back to Rational Investing. My name is Cameron Stewart. Thank you very much for joining me. This is part 2 of our 6-part series on the airline stocks. Behind me is Southwest. Let's dive right in. What you'll see here is Southwest Airlines began with $15.6 billion in 2011 of top-line revenue. They've been able to grow that successfully at 4% over the decade to $22.4 billion. Which is okay growth. Not great, but above inflation. If we go forward into the EBITDA, we'll see here that they've been able to grow EBITDA at even faster at 17.5 or 18% annual growth rate, beginning at $1.4 billion and ending at $4.2 billion of EBITDA. That's fantastic growth. That means margin expansion. That means management's doing what they need to do to squeeze more dollars out of every seat. And I like to see that. Let's move forward and take a look at enterprise value. So here we're picking up the debt from Southwest. Again, total long-term, total short-term or current portion of long-term debt, any pensions or any leaseholding obligations they have. They ended at $4.1 billion, which is roughly flat for that time frame. Market cap is share price times outstanding shares. Enterprise value goes from $10 to $33 billion, primarily on the back of increased earnings. Here's your valuation metric. So Southwest Airlines has averaged 8 times EBITDA over the decade at a high of 10, a low of 6.5. Pretty consistent what we've seen in the industry. Debt to EBITDA here is really nice. So they started a little high of 2.7 and they brought that down to 1 times EBITDA, which is very nice. Again, we like to see 3 or less. 1 turn of EBITDA is a very low levered company, and that's a great position to be in. All right, let's look at cash flow. Behind me is Southwest cash flow. They started the decade in 2011 with call it $1.4 billion of operating cash flow. They have grown that to almost $4 billion of operating cash flow over the decade. That's a 13% annual growth rate, which is very consistent to the 18% that we saw in EBITDA. CapEx, again, CapEx is the reinvestment in their business, the buying of airplanes. You can see here that the CapEx number each year is less than the operating cash flow number. That means they can afford to reinvest in their business. It's a great thing to see. You'll also notice that the debt payments have been largely negative the entire time, meaning they're paying down debt over time. Another good hallmark of a well-run business. Finally, shares outstanding here. Shares outstanding have fallen 30%, beginning at 774 million shares down to 538 million shares. Meaning, if you had a share here and you held it for the decade, your share owns the company 30% more than it did previously. That's fantastic. That's not doing anything but just literally growing your percentage ownership of a growing company. That's compounding. It's great to see. Cash flow per share is strong and growing. Share price and a yield. A strong yield at 4.7% with a solid growth rate of 62%. Overall, this one, top line revenue growth is check, EBITDA growth check, low debt is there, and free cash flow is there. So solid 4 factors. We'll take a look at price in a second. Let's forecast future value. Excuse me. If I go forward and I take our average free cash flow that they've experienced in the last 3 years, and I drag it forward in time with a very small kind of mediocre growth rate for what they've experienced. But given the corona issues and the uncertainty of the airlines, I'm zeroing out cash flow for 3 years to help them afford whatever debt they're going to have to take on to survive. That gives me a price target of $105 a share. If I do the same logic but for EBITDA, right? Average EBITDA the last 4 years is 4.4. This is not going to materialize in these couple years, but long term, I think they can get to $6.3 billion of EBITDA. Using an industry average multiple, I get a $52 billion enterprise value. Less debt is a market cap a little shy of $45 billion. The outstanding shares I have increased 10% for any dilution that this debt through bailout might require them, and I get a $76 share price. If we look at that compared to the current price is $23.33. Here's our two valuation metrics, free cash flow method and the enterprise value method. I'm going to average the two for a $90 future stock price. We'll take a look at the IRR here. So I'm buying at $23. I get a little cash flow and I exit at 90 after a decade. That's a 24% annualized rate of return, or 5 times your money over the decade. Very robust, certainly one of the strongest we've seen here on this channel thus far. And we'll see how this stacks up with the rest of the series in part 3. My name is Cameron Stewart. Thank you very much for watching Rational Investing.